Welcome back. Slew of economy numbers, both US and India. Economy numbers from the US are only getting stronger. The latest retail sales data for January showed that sales grew at a steaming 3% compared to street estimates of just 1.9%. That much better than expectation. This is in spite of the fact that prices are continuing to remain elevated. As we know, just a few days ago, US CPI inflation came in higher than market expectations at 6.5%. In India, too, inflation for January was an ugly 6.5% versus expectations of 6.1%. The good news on the macro front in India is the January trade deficit, which has fallen to a 16-month low of $17.76 billion. If you add goods and services, the monthly deficit is practically nothing. $1.27 billion. So, is this good news for the rupee? To get a handle on all things macro, US, global and India, I have with me Sameer Goel, Head of Emerging Markets and Asia APAC Research at Deutsche Bank. Sameer, thank you very much indeed for joining us. Let me first start with the US data. The retail sales number coming in very strong. The yields did move higher, 3.8 on the 10-year, and then they moved off a bit. But really, what is the market figuring in or factoring in terms of rate hikes?
So I think in the US, I think the macro narrative over the last few days has indeed been shifting quite a bit. You can see that in the price action in terms of how the terminal rates have really moved by a good close, sort of above 30 basis points. There is more than a hike which has been added on to the market's interpretation of where the Fed would take rates to. I think particularly influenced by the payrolls numbers, and then after that, the inflation print. In our view as well, we have, as a house, very recently pushed up our terminal rate forecast by 50 basis points to now the range of 5.5, 5.75 as where the Fed will likely peak at. I think as you said, a lot of the data has been very good. I think the glass half full interpretation of it is that probably means that there is a larger scope for the economy to be able to achieve a soft landing, because it feels like it's a lot more resilient to all the tightening we have seen thus far. Maybe a glass half empty interpretation is that if indeed the easiest part of disinflation is over, then does that mean the central bank have to do a lot more potentially to be able to correct the demand function and bring the economy back into equilibrium? And that is probably a lot less positive for risk assets than the former interpretation would be. I think the market's trying to struggle in between those two interpretations at the moment. Mostly the risk assets have taken it positively, but you can see that there's disconnect happening between risk assets and equity markets, which are taking it very positively, versus bonds and fixed income, which very clearly, as you said, with the yields kind of pushing higher, both on the terminal rate, but also on the back end of the curve.
Okay, actually, I want you to choose now which side things may move. The first question is whether you're saying 5.5, 5.75. When I looked at the CME Fed Watch tool, it looks like 5/4 has been, kind of absorbed by the market. But you're saying that you're expecting 3 more rate hikes, right?
So we are actually expecting 4 more rate hikes to come through. So there is 4 more 25 basis points of rate hikes to come through. We do think the Fed has moved down to a 25 basis point clip, but will continue to do a hike now till July. Our expectation before this was for sort of the 5.5 quarter range, and has been pushed up by 50 basis points. And my point was the market curve was up until very recently, just before the payrolls, was pricing in a terminal rate of below 5%, and that's kind of pushed back up to about 5.30. So I think in general, the narrative has moved towards the idea that the Fed would likely need to do more than what was earlier expected, because the easiest part of disinflation maybe is already done, and it's not very clear. And maybe in that sense, the narrative very similar to that in India, which is that core inflation is proving to be relatively stickier than expected on the downside.
Oh, absolutely. I'm just coming to India in a minute. But, in spite of your estimate that I think you would be an outlier when you say you are expecting another 4 rate hikes. I heard someone speak about even 6% Fed funds rate, but that is still the minority from the kind of economists we hear. Now, in spite of it, growth seems to be doing very well. So do you think that equities ought to be chased even now? Do you think they have a lot of leg room? Also because a softer recession is expected, and also because the Chinese opening up has been steady and is creating growth opportunities. So do you think the growth assets, risk assets, have some more legs to run?
So I think I'm not an equity analyst, but I would say exactly the point I made, which is that the risk assets need to be able to make that balance between the idea that whether good news is indeed good news in terms of the economy, which is almost certainly proving, and in the US in particular, but also to a large extent in Europe, which has seen growth upgrades over the last few weeks, that clearly the economy is proving to be very resilient. But together with the resilience and the fact that we are looking at jobs markets tighter than they've been in a very, very long time. Also, the risk that like I said, the easiest part of disinflation is done, and the risk therefore remains that we are not able to actually get to or on that same glide path towards a target as well as what central banks would want them to be, which is why you've clearly seen a shift in rhetoric from central banks pushing back against the idea that their work is already done, and they probably want to get financial conditions tighter in order to be able to ensure that the process of disinflation remains. So I think the risk to that extent, or risk assets, what they have to tend with this fact that is good news always good news, or is good news then potentially also not so good news when it means that you need to tighten financial conditions further to be able to bring to a more stable, longer-term equilibrium.
Okay, so you're basically throwing a question there whether financial markets are ignoring the potential rate hikes to their own peril. But yeah, we will have to wait for that answer. Samir, what about the Indian inflation number itself? It came in much higher than what the street was expecting, and it is coming in a global context where inflation is proving to be sticky. How much more would you expect work from the Reserve Bank?
So I think even for India, just like it is the case elsewhere, I think there is a part of the obvious disinflation which is coming because of base effects. And I think that will continue to be the case over the next few quarters. But it's also important in India context, of course, to look at which part of inflation is coming core and which one is coming really outside. And I think one of the concerns which the Reserve Bank has very clearly expressed is about the fact that any disinflation which we have seen thus far is also not particularly broad-based. In fact, if you look at narrower measures of inflations, for example, excluding vegetables, you see a level of inflation which is in fact even higher than what the headline inflation would suggest. And that clearly causes discomfort, as it should for any central bank, as to whether there is sufficient amount of traction which has happened thus far from tightening. Now, RBI has been, and as they said in their latest statement, and the governor made the point that we need to obviously be patient to see the lagged impact of tightening coming through. But to our mind, I think the CPI number has almost definitely increased the probability that we are not already at the peak, and that RBI will probably tighten one more time, another 25 basis points we feel for April to take it to 675. At this stage, it looks like that will be the peak. But again, I think just like with everywhere else, I think the proof is ultimately in the pudding. We need to see the trajectory of inflation and how it behaves in terms of the lagged impact of policy tightening to be sure that that's exactly where we peak out. The risk, if anything, I think for global policy cycle, it does remain that central banks have to take rates higher or keep them there for longer than maybe what is still currently being expected.
Okay, just to come back to the US for a minute, you're penciling in 5.75. What's your estimate of the dollar index? We saw it go almost to double digit and then rise again, but not so much, 103, 104. If you're seeing so many rate hikes, are we going to see once again a dollar surge?
So good question, Lata. I think, again, the dollar to our mind, and for bulk of last year, was really more an expression of the safe haven bid given all the various multiple macro risks we faced with. Inflation was one of them, as indeed was the entire pickup in commodity prices and macro risks around, of course, what was happening in Russia, Ukraine. It was also about the demand shock from China's zero COVID, etc. A lot of those headwinds, I feel, are kind of turning now, are certainly improving. I think it takes a bit of time and there's a period of transition. So we are of the view that the dollar has, from a medium-term basis, the cycle has turned. And as you said, it has also come off a fair bit, bounced a little bit off recently. I think the part which is still missing from the dollar is that we have not as yet got clarity on the peak of the Fed cycle. And I think till we get that, I think it's going to be harder to have a unilinear move lower in the dollar. That still remains our view for the year, that the dollar will head lower. But I think it needs more clarity on the terminal rate. It looked like till a few weeks ago that maybe we were getting close to the terminal rate. But of course, the latest numbers, both on the jobs market and on inflation, has clearly sort of clouded that outlook a little bit. And it's kind of pushed out, like I said, even for our own forecasts, has pushed out the fact that the terminal rate will now probably only come by the middle of the year and will probably come 50 higher than where we were earlier thinking.
Okay, so you think the dollar index could go to, say, 105 or more before it recedes?
So I think, yes, the dollar index will now have to balance the two bits. Look, to our mind, dollar is definitely an overvalued. In fact, on our models, is the most overvalued currency in the world.
Okay.
It's also true that the world has a lot of exposure to dollar, a lot of very unhedged exposure to dollar. So for a lot of metrics, the dollar does look expensive. But what is in its favor is the fact that it happens to have the best safe haven bid.
Okay.
And the fact that as long as the Fed is still tightening rates, it still remains a relatively high yielding currency, especially in among the other developed market currencies. So I think, again, the medium-term trend in the dollar is now lower, but it's not going to be all that clear till we get clarity on the peak of the Fed cycle.
Okay, let me try and squeeze in two questions now because I'm running out of time. The trade data was absolutely, flabbergasting with the goods plus services deficit coming down to barely $1 billion. Even the goods deficit alone at 17 billion is far less than the average from April to December. So is there scope for now rupee strengthening? And also this year, do you think the FPIs will buy Indian bonds?
So I think, the rupee domestic idiosyncratic factors, except for obviously, as always, the vulnerability to commodity prices being higher, I think a lot of the domestic factors are now not necessarily quite as negative. And particularly, even though we still don't have clarity on inflation, but it looks like RBI is really on the case and is unlikely to sort of pull back till it is convinced that the inflation issue is well under check. So I don't think the domestic factors are necessarily negative. I think where the rupee's trajectory from here on is a little bit more contingent on is what happens, as you said earlier, to the dollar index. There is a little bit of a risk that till we get the peak of the Fed cycle, that we still continue to be in a choppy kind of a range for the dollar. But I think the domestic factors, including, like you said, the trade gap, certainly points to the fact that the worst from an India macro fundamental perspective for the rupee is behind us. Do we look for bonds? I think, again, needs more clarity on the peak of the RBI cycle, and of course also around more clarity maybe on the bond inclusion issue. But more generally, yes, I think emerging market assets and including in India fixed income remain terribly underowned. So our view is certainly that as we get to the peak of the global rate cycle, and particularly in the Fed, we will see more money come into emerging market fixed income and including in India.
And that should benefit the currency, I would assume. Thank you very much, Samir Goel. Out of time, but pleasure speaking with you. So there you are, macros on the watch on inflation, but definitely on the currency. There is a lot more space to be relieved, not too much of pressure. We wind up on Bazaar, but Chartbusters coming up with an exclusive interview with Mr. Gunjan Shah, the Managing Director and CEO of Bata. He's here in just a few minutes to discuss their Q3 numbers.
Co-powered by